Over the last few weeks, we have seen record highs in the stock market, which of course entices everyone to just buy everything they can. But that of course is not all just sunshines and rainbows. When we start seeing the market start declining, that is when people start selling, which is the opposite of what we should be doing as an investor. Now, the number one reason why investors do fail in the long run is time. When they start looking at setting a timeline, when they set a specific goal, whether it be a year, 5 years, 10 years, retirement, what exactly does that look like? We're going to go through and break down and really show you the reasons why investors do fail and why they do struggle to earn wealth during investing. And even looking at some of the funds that we do have, such as Vanguard's popular S&P 500 fund, the VFINX, if you kept your money invested with this, you'd essentially have an annualized return of 13.8% over the last 15 years, 11.9% over the last 10 years, and 15.5% over the last 5 years, which is kind of incredible to think. The longer that you have this, you are still yielding almost 14% over the last 15 years. So of course, when it comes to investing, like we were talking about, it is a long-term success. It is a long-term marathon. When you look at some of the most famous investors that we see, like Warren Buffett, majority of his wealth was built after the age of 65, which means when he started investing at 11 to the age of 65, that is long-term success. That is what it looks like. When you look at an individual that has $131 billion, most humans will not compete a marathon and will not ever go out for a marathon. When it gets tough, they will quit. When the market is down, they will quit. That is what I see. It is really the rationalization of the asset allocation, which means stock market starts coming down, they sell, just like we see continuing to drive the market down. When the stock market is doing well like it is right now, we are seeing record highs, a little bit of a dip or a pullback. We see record highs again, record highs again. Now, when the stock market does start pulling back and starts rebounding, we see people selling and we see people that are not holding at all. They want to take profits. They're getting out of the market. However, if they would leave the money in the market, and again, I know this is kind of human nature, but leaving money in the market is the most successful way to build wealth, because we have seen, even when you look at statistics going back years, if you miss the few highest days of the market, you essentially would cut your returns almost in 50% during that same time frame if you didn't leave it in there for the extended duration. Also, when it comes to investing, a majority of Americans don't put in enough money to actually make a substantial difference, where if they're putting in 4%, let's say over a 20 or 30 year period, it's going to grow a little bit, but it's not going to be the massive compounding interest which it needs to be. They're waiting and looking for the next Microsoft or Nvidia or Amazon to put money into, instead of just dollar cost averaging, putting funds on a regular basis with a decent amount. When we start looking at that, 10% is probably the minimum that I would recommend. 15% is really what Dave Ramsey says, and 15% will get you well above where you need to. And ultimately, if you get to retirement and you have more money than you need, great. You don't have to burn through it all. You don't have to spend it all. However, on the flip side, if you get to retirement and you don't have enough money, guess what? There's no way, and for a majority of people, not enough time left or not enough health if they can't work a regular 9-to-5 job to actually go ahead and add on some additional income. Now, of course, when you look at investing as a big picture, there's a lot of difference in a lot of people that I work through financial counseling. And of course, looking at some of the things, there's a strong difference between speculation and investing. Speculation is what a lot of people do on YouTube. They think about a portfolio, they think about a build, they look at low cost index. A lot of people looking for what is the next big winner. What are people saying? What is the speculation? What is the federal government going to do? Guys, the federal government doesn't care what you do as much as you shouldn't care really what they do. They're going to do what they're going to do almost regardless of what we do say. But of course, you can take control and you can have the ability to not just speculate, not sit on the sideline, but actually get into investing, which is what I do. And the reason why I share all of my personal portfolios with you guys. That way you know exactly where I'm investing my personal money. Now, I am not a financial advisor, but I have seen the portfolios. I've worked with a ton of them through the years, and it works incredibly well. Now, before we look at the next one, go ahead and subscribe to the channel. Let me know in the comments what you guys think. Give it a thumbs up. And getting into the next one is the personal psychology. Now, this is the news flash. This is the emotional tie that you have to get away from when it comes to investing. When they talk about, people, what is hot, what is buying, what you should look at, what you should sell. You don't want to lose money. This is going to go bad. The media is going to, and it has always really distorted the view that we have of companies, which is the reason why a lot of people, including Warren Buffett, really doesn't pay a lot of attention to it, because it is the long-term investing. Now, of course, humans, and being very unique, have the ability to delay gratification. So what this means, if you want something, you want to buy it now. That is why we have an exorbitant amount of credit card debt. That's why we have the buy now, pay later. Really stopping to ask the hard questions. Do I need it? Do I want it? And how bad do I really need it? A lot of people have said, thinking of a frugal mindset, where if you can wait 3 or 5 days to see if you really needed the item that you wanted to buy right then and there, you could really see it. And of course, when it comes to stock market and when it comes to investing, you have to make sure that future desires and putting money into the stock market is not essentially the buy now, pay later scheme, where you're going to put a little bit of money in, you need it for something, you're pulling it out, you're spending it in other places. Then, of course, the unwillingness to be satisfied with good enough. They want the perfect portfolio. A lot of people that build a portfolio will change it on a regular basis. We'll see every couple months. They'll buy, they'll sell, they'll research. They're not buying and holding. And a lot of it is on ill advice. A lot of it is on, people who might not be the best professionals in the marketplace. Everybody is going to have their own kind of turn on the marketplace, or really their own speculation on it. Now, for me, it is ETF investing. I know a lot of individuals that do individualized stock investing that build complete portfolios based on single stocks. Personally, I don't want the time, and I don't have the time and the effort to research companies individually, which is the reason why I do buy those ETFs in their entirety. It makes sense to me to not only have the risk diversification, but also looking at the returns that they're yielding with these index funds. And of course, the number one reason why investors fail is second guessing themselves, making huge portfolio changes after receiving new information, which is usually from an expert. When you think of Mad Money, with Jim Cramer, when you look at a lot of the experts, again, they have a different view of the stock market that you have. Too many investors try to time the market. We know this is nearly impossible, which means that no one is smart enough to actually do it. And if you do it, you're only lucky. That is often the buy high, the sell low, really recipe for disaster. Why we see a lot of stock market people get out and really pull the money out. Also, they get burned. So they put money into the stock market, it goes down 5%. All of a sudden they're selling it, they lost 5%. Boom, they are not going to go ahead and they're not going to invest anything else in the stock market because I lost money and they were burned. We see this with a lot of different industries. We see this with a lot of different places. Now, when you start looking at the big picture, this is what people have to realize. If you're starting to work at, let's say, 18 to 20 years old, you start to work from 20 to 60, you have 40 years. That is the window. If you're retiring at 55, maybe a little bit early. So let's say 35 to 45 years of your working years that you have to invest. If you're investing 10% of that portfolio, when you get to that age 60, 65, you are going to have millions of dollars in there guaranteed. Now, you gotta, of course, make sure that this is in a properly kind of regulated ETF. You wanna make sure that you're not putting it all into individual stocks, which again, for some individuals, it could make sense. You could actually make a lot of money that way if it is in the right company. But for me personally, ETFs are the way to go. So a lot of people also think common sense. What does common sense tell you? Very, very dangerous trap, especially for investors. When you think of this, you don't know the future. And when I look at ETFs, when I look at stocks, when I look at bonds, when I look at anything, we are basing it off of past performance. That is really the only thing that we have indicative, short of looking at earning statements of actual companies and seeing how the companies themselves that are held within those ETFs or those stocks actually perform, which would make a really big difference. But again, very, very time consuming. So what are two things that you can do to really get out of failing as an investor? Number one, good long-term plan, put it fully automated, set it and forget it. This means going into your 401k plan, if that's what you're contributing to, putting your 10 or 15% into that plan, putting it into some of the stocks or bonds that they offer, making sure that you have a set plan. Boom, your money is going to go there every single paycheck. You can set it and you forget it. If they don't offer it, definitely use M1 Finance down below. Open up a Roth IRA for that. And you can actually, again, do the exact same thing. You can automate the contributions going in there, which makes a big difference. And then the second part, if you're not good at doing it, if you don't want to index funds, if you don't want to worry about stocks, you don't want to worry about anything, find a financial advisor to do it for you. Now, of course, this is going to be someone you want to interview. You want to go through an interview process. You want to see what makes sense. Do your goals essentially align with what he's doing and how he's investing your money? What does the risk kind of look like in there? Make sure that when it comes hand in hand, your interview process with a financial advisor. In addition, what are the fees? Are they charging you 1%? Is there an annual fee? Is there a monthly fee? Make sure you know the breakdown when you start investing. And of course, through constant contributions into a plan, regardless of if it's managed yourself, if it's managed by another company, you can be a long-term and very, very wealthy investor. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.